Most timely trend for FIA here is the recent guidance that we've gotten around Bitcoin ETF options. Cboe is listing venue for 2 of those ETF options. We've been waiting for that guidance for a while now, and in getting it, we're excited to start to open up kind of a listed, centrally cleared, transparent market in an asset class such as Bitcoin.
How have the VIX futures and index shaped Cboe's approach to product launches?
The VIX has been a real, kind of sandbox for innovation for us. It started back in 1993 when we launched the index itself, and then tradable futures in 2004, and then in 2006, the options. So that really laid the groundwork for a tradable volatility contract. We continue to try to expand that footprint today. Just recently, on October 14th, we launched options on VIX futures. And so the big thing there was it just gave a new access point for new traders to be able to trade optionality on VIX. And what I mean by that is options that are on futures are now regulated by the CFTC. And so traders that don't trade in the securities world never had the ability to trade options on VIX, and now they do. So that was one piece of the market that we were trying to give access to. Second was for traders that wanted a shorter dated option. And so in creating VIX options on futures, we were able to create an option that we could list a daily contract on to take advantage of some of the, growth that we've seen in short-dated option trading. And so with this option on VIX futures, we launched with the front 5-day contracts, and then we moved into launching an additional 2 Fridays.
What is the strategy behind S&P 500 Variance futures and options?
Variance was a great addition. With VIX, you're trading forward implied vol. Really does nothing to look at what happened. It's purely what does the market expect is going to happen over the next 30 days. So when we introduced the Variance futures contract, Variance trades the realized vol of the S&P 500. So it's more of a backward-looking contract where if I trade VIX, and let's say I initiate a trade at 20, over the next 5 days, the VIX goes up to 25 and 30, and maybe comes back down to 27, and then on that 5th day, it finishes on 20. Well, you started at 20, you settled at 20, and you break even on the contract. Whereas Variance, if you start at 20 and you go up to 25, you go up to 30, come back down to 27, all the way back down to 20, it's a realized contract. So your payout is the average over the course of those 5 days. So you're benefiting from the actual realized moves that happen in the market. Why that's important is you take a purely implied product, you combine it with a realized product, and you can start to really structure your portfolio around the different volatility moves that take place in the market. And so that was just a great addition and something that the customer base had been asking for a while now. I should add that we've launched Variance before, but the reason previously that it was not successful is I don't think the market was ready for it. A lot of regulatory changes have taken place over the last few years with unclear margin rules and things of the like, where now it became much more costly to trade in the over-the-counter market, and really that variance market dried up. So we had a lot of inbounds coming from banks, hedge funds, even insurance clients that said, I don't have the liquidity that I once had in the over-the-counter market. Could you bring back a listed product? So we're really excited to get that feedback and then reintroduce Variance futures.
What is VIX TLT?
It's an index, so it's not a tradable product, but it really is the index that helps you see the relative performance difference between a VIX or volatility on treasury bonds, so a VIX methodology on the TLT treasury bond ETF, and then you can compare that to the VIX index itself, which is looking at equity vol. So it's an apples-to-apples comparison of equity vol to treasury bond vol, which now gives those that are looking at the two markets kind of a relative performance metric that allow them to track strategies and look for maybe timing when they put on a trade. So that's kind of the identify piece. Then we go into the tradable piece. So if we can help traders identify opportunities, we need the products to be able to take advantage when those opportunities present themselves. So you mentioned the emerging markets sovereign bond futures. We launched those earlier this year, and that's now just giving a new exposure, a more diversified exposure to our traditional futures offering. So VIX really anchors our futures offerings. We started to go into the credit markets. We launched high yield and investment grade corporate bond index futures on the iBox product. And then we've expanded that most recently with the S&P Emerging Market Sovereign Bond Futures. We're just trying to diversify and give people as many tools as possible.
What is most important in making product innovation successful?
It's listening to your customers. So a lot of what you're seeing and a lot of the activity that we've had in releasing new products are really driven by the market. It's people coming to us, like I mentioned, with Variance futures and saying, there's a need. The OTC market isn't working like it used to. Can you produce a listed product to help us get that action again and give us a risk tool that we can help manage our portfolios with? And so first and foremost, it's driven by customer demand. And then we look at our product set and say, where's the next spot we can diversify? Because that's another thing. Obviously, when it comes to CFE, we're talking a lot about futures. Like offering a more diversified product set gives people more reasons to connect to the exchange, more things to be able to trade. So you anchor it with a product like VIX, and then we keep introducing new products on a more diversified front so that as people connect, they get more and more utility out of connecting to something like CFE.
Why are index partners important?
Index partners are one of the most important things to us in product development. You have to go where the money is tied to, correct? And so, I don't even know what the most recent numbers are, but it's something like $14 trillion, I think, is tied to the S&P 500. So obviously, when you have that level of AUM tied to an index, you need products to be able to help manage the risk. As the index goes up, as the index goes down, do you have the right products that help you properly manage that risk and through any market environment? So having good relationships with our index partners really drives that product innovation. Whether it's talking to FTSE Russell about the ability to launch a Russell VIX, or MSCI about some of the product launches that we've had recently around our emerging markets and EFA VIX, or into some of the tradable products that we have with regards to the ACME options, US options, and the world options. Once again, we're working with the index partners. We're listening to them on where risk is tied to in the market and where those customers need tradable products on an exchange like Cboe's to be able to manage that risk.